This video is for Finance 304. It's additional discussion for the Chapter 12, Commercial Banks Financial Statements and Analysis in the textbook. First, I'd like to start by explaining why we evaluate the performance of commercial banks. Commercial banks, as we know, are unique in the special services that they perform and the level of regulatory attention that they receive. They help administer the flow of funds through the economy, and they present a significant amount of risk to the economic health of our country and the globe, and it is important that they are evaluated and analyzed regularly. Because of the activities they perform, they are also unique in the type of assets and liabilities that they hold compared to a manufacturing firm or other types of corporations. The ultimate measure of a commercial bank's performance is the value of its common equity to its shareholders, similar to other types of entities. Financial statements of commercial banks are ideal candidates to use in examining the performance of depository institutions, given the extensive regulation and accompanying requirements for public availability of financial funds. Regulators use CAMELS ratings. It's called CAMELS. It's just an acronym for the different components that they evaluate. They use these to evaluate the safety and soundness of commercial banks. And these ratings and the evaluation of them relies heavily on financial statement data. The components are capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. Financial statements for commercial banks are held at the Federal Financial Institutions Examination Council. You can go to ffiec.gov and look up financial data on any commercial bank in the nation. They prescribe uniform principles, standards, and report forms for all depository institutions. And the financial statements of commercial banks have to be submitted to regulators and stockholders at the end of each calendar quarter. Financial information on commercial banks is reported in two basic documents. The first is the balance sheet, which is also called the report of condition, and this presents financial information on a bank's assets, liabilities, and equity capital. The second of two documents is the income statement, also referred to as the report of income. This document presents major categories of revenues and expenses and the net profit or loss for a bank over a period of time. All financial institutions, and particularly commercial banks, are also engaging. It's important to note that they are engaging in an increased level of off-balance sheet activities. This means there are certain contracts that many commercial banks enter into that don't show as an asset or a liability on the balance sheet. They are called contingent liabilities, and they only move to the balance sheet as an asset or a liability if some clause in the contract is enacted. So those are complex, they're difficult to measure and predict, and they have introduced a new type of risk to commercial bank analysis that is difficult to quantify. So it's important to know that they exist and to understand that the only way you can see information on them is by reading the footnotes of the financial statements. So let's go back, get our minds off the off-balance sheet activities. That was kind of a little bit of a tangent, but going back, let's talk about the first of the two most prominent financial statements for banks, which is the balance sheet. The balance sheet is the same as the basic balance sheet that you learned about in your accounting classes. And in corporate finance, it has assets, liabilities, and owner's equity. Assets will be listed on the left side of the balance sheet. Liabilities and owner's equity will be on the right side of the balance sheet. And the left side and the right side of the balance sheet must balance, meaning that the total amount of assets must always equal the total amount of liabilities and owner's equity combined. And we've already talked about the off-balance sheet activities that also exist, and those are frequently described in the footnotes to the accounts. Assets on a financial institution or commercial bank's balance sheet include cash, investment securities, loans and leases, and other assets. Liabilities consist of deposit accounts and other borrowings that are used to fund the loans and investments on the asset side of the balance sheet. So the assets of a bank are loans for the most part. The liabilities of a bank are deposits and other borrowings like deposit accounts, CDs, borrowed funds. Those are the three things, and capital. Those are things that exist on the right side of the balance sheet under liabilities, and the deposit accounts and the other borrowings are what a bank uses to fund all of the loans and investments that exist on the left side of the balance sheet. Off-balance sheet assets and liabilities are contingent assets and liabilities. They may affect the future status of a bank's balance sheet. Off-balance sheet activities include loan commitments, letters of credit, loans sold, as well as derivative securities. And those are talked about in the chapter in detail. I'm not going into detail in this discussion about those. So the income statement, the textbook provides multiple examples of bank income statements, and it is a document that lists out, it starts with interest income, which is all of the income and fee income on the loans that the bank issues. Interest income is the largest income producing category for a bank. So there are multiple ways that a bank can produce income, but interest income is the most prominent. The next item on the income statement is interest expense. Interest expense is the second major category on the income statement, and the items listed here come directly from the liability section of the balance sheet. So your interest expense is the money that you're paying to customers that have deposit accounts at the bank. It's the interest that you're paying on your CDs or your savings accounts. That's what your interest expense is. So net interest income on the income statement means interest income minus interest expense. So you want your interest income to be larger than your interest expense if you're going to have a profitable bank. The next item on the income statement is the provision for loan losses. The provision for loan losses give me just 1 second. The provision for loan losses is it's the current period's allocation to the allowance for loan losses that's listed on the balance sheet. So the line item on your income statement called provision for loan losses is equal to the amount on the balance sheet that says allowance for loan losses. And it's not actually a cash amount, but it's an expense deducted in your income statement that is supposed to represent the number of loans that you will have a loss on. Non-interest income is all other income received by the bank as a result of on and off balance sheet activities. So, non interest income includes fees that you charge your customers other than interest on loans. Then you have non interest expense, and non interest expense is any expense the bank has other than interest paid to depositors. So, your non interest expense is mostly personnel expenses. It's also your overhead expenses and facilities expenses. Your non-interest expense is generally large relative to your non-interest income. So your non-interest income is, there's only so much you can generate in the bank, and it's usually smaller than non-interest expense. So the bank has to make up for that by having interest income that is greater than the interest expense. So you have a positive net interest income in order for the bank to be profitable. Continuing down the income statement, you have income before taxes, then you have the income taxes that are deducted from the amount, and then the final amount on the income statement is net income. So we've talked about the structure of the balance sheet and the structure of the income statement, and in your Chapter 12 quiz, you actually use an income statement and balance sheet for a bank that have all of these categories on them. But one of the things that we should discuss is that the relationship between the income statement and the balance sheet of commercial banks. And the textbook provides this formula for the relationship between the income statement and the balance sheet. And it can look a bit intimidating, but it's actually very simple. Net income for a bank equals the sum of the rate charged on assets minus the sum of the rate charged on liabilities. So you take every asset in the bank and multiply it by whatever interest rate the bank is earning on that asset, and that calculates your profit on assets, your income on assets. Then you subtract the sum of the rate that you're paying out on your liabilities. And then from that, you subtract your provision for loan losses. Then you add in your non-interest income. You subtract your non-interest expense, and then you subtract your taxes. And that's really the formula for the income statement. The reason the balance sheet is related closely to the income statement is because if the amount of assets change on the balance sheet, it changes the A in this formula, and it will change the net income by that amount based on the amount of the asset and the rate that is charged, the income stream that is generated from that asset. So you can see the relationship between the two documents, the income statement and the balance sheet. Next, let's talk about financial statement analysis. So in financial statement analysis, we're simply taking a handful, or actually there are quite a few ratios that analysts look at. But ratio analysis allows a bank manager, like within the bank, you use all of these ratios, but also outside of the bank. Regulators use ratios to analyze a bank. Investors may use these ratios to analyze a bank. Internally, the bank manager evaluates the bank's performance using ratio analysis. So they not only analyze the current performance, they also evaluate the change in performance over time, and this is called time series analysis. And they also evaluate its performance relative to that of competitor banks, and this is called cross-sectional analysis. There is a report, it's called the UBPR, or Uniform Bank Performance Report, and this is available on the FFIEC website. It's a tool that is available, it's publicly available to assist in cross-sectional analysis. You can also do time series analysis using this tool. But it summarizes the performance of banks for various peer groups, for various size groups, and you can also sector it by state. Okay, the textbook talks about ratio analysis using the ROE framework, and really it does this so that it's just showing you, or it's trying to illustrate the relationship between all the different ratios that you use in financial statement analysis. So it begins with ROE, and it breaks it down to identify the strengths and weaknesses in a bank's performance. So starting with ROE, it measures the amount of net income after taxes earned for each dollar of equity capital contributed by the bank's stockholders. So your ROE equals net income divided by total equity capital. The ROE can then be decomposed into two component parts. So ROE actually equals ROA times the equity multiplier. So ROA is net income divided by total assets, and the equity multiplier is total assets divided by total equity capital. As you continue through the ROE framework, we look at ROA. Our return on assets determines the net income produced per dollar of assets, and the equity multiplier measures the dollar value of assets funded with each dollar of equity capital. So the higher the equity multiplier ratio is, the more leverage or debt the bank is using to fund its assets. ROA can then, as we go further into the ROE framework, we break down ROA. It's broken down into two components. First is profit margin, and then is asset utilization. So if you take profit margin times asset utilization, you will get ROA. Profit margin is net income divided by total operating income, and asset utilization is total operating income divided by total assets. Return on assets and its components are continued here. We talk about profit margin, which measures a bank's ability to control expenses and thus its ability to produce net income from its operating income or its revenue. A breakdown of profit margin can isolate the various expense items listed on the income statement. So as you break it down, you can look at interest expense ratio, provision for loan loss ratio, non-interest expense ratio, and the tax ratio. Then we work into the asset utilization, and that measures the extent to which the bank's assets generate revenue. So our asset utilization ratio equals total operating income divided by total assets. Additional ratios that are important when looking at financial analysis. First is the net interest margin, and this measures the net return on a bank's earning assets. Net interest margin equals the net interest income divided by earning assets. And broken down further, net interest income is interest income minus interest expense, and your earning assets are your investment securities and your net loans and leases. An additional important measurement is the spread, and this is the difference between the average yield on earning assets and the average cost of interest-bearing liabilities. Your spread is calculated by taking interest income divided by earning assets minus interest expense divided by interest-bearing liabilities. So this is your spread between your interest income and your interest expense. An additional ratio is overhead efficiency, and this measures the bank's ability to generate non-interest income to cover your non-interest expenses. So your overhead efficiency is non-interest income divided by non-interest expense. And many of the components of our key ratios provide additional insight into the financial stability of banks. There are several others. You can see the decomposition of profit margin in Table 12.6 in the textbook, and the decomposition of the asset utilization ratio in Table 12.7. It's also important to note the difference between large banks and small banks. It's important to know never to try and compare a large bank to a small bank when you're doing a financial analysis, because they don't operate in the same way. Retail banks, wholesale banks, and community banks operate in different market niches that should be noted when performing financial statement analysis. Large banks have greater access to purchased funds and capital markets compared to small banks. So our large banks generally operate with lower amounts of equity capital than small banks. They generally use more purchased funds and fewer core deposits than small banks do. They tend to put more into salaries and premises than small banks do. And finally, large banks tend to diversify their operations and services more than small banks do, and they also generate more non-interest income. So large banks are able to generate more non-interest income than small banks, mostly because they diversify their operations more. They provide more services that they can charge fees for. Just wanted to make note here, as we're preparing for the midterm exam, on the midterm exam you will be required to calculate ROE, ROA, profit margin, net interest margin, spread, and also asset utilization. For some reason my pen is not working, or I would write asset utilization for you guys here. So be sure and I want you to understand what all of the ratios mean and how analysts use them, but I just need you to know how to calculate these 6 ratios, including asset utilization. Okay, that's it for Chapter 12, Finance 304.